Good evening to all the participants. This is R.S. Kiran, and we are organizing this investor awareness program in association with Association of Mutual Funds of India. And this is being organized from Entrepreneurship Development Cell and Institutions Innovation Council of Sanketika Vidya Parishad Engineering College Autonomous. Now, regarding the Sanketika Vidya Parishad Engineering College, it was founded as a premier promoter of quality education in Visakhapatnam of Andhra Pradesh in 2003 under the Srinivasa Vidya Parishad Trust, and Dr. S.V.H. Rajendra Garu, as a founder chairman, promoted this educational institution with a mission to offer the best engineering education with unmatched innovations in the process of teaching and learning by aiming at the holistic development of the students. The college is situated in an eco-friendly area of 32.5 acres with thick greenery of PM Palam behind YSR International Cricket Stadium, Visakhapatnam, Andhra Pradesh. And the campus is 300 meters away from PM Palam, National Highway number 16, 10 kilometers away from Visakhapatnam RTC bus stand, 12 kilometers from the Visakhapatnam railway station on Howrah Central Railway line in South Central Railway, and 25 kilometers from Visakhapatnam International Airport. Sanketika Vidya Parishad Engineering College SVPEC is approved by AICT, recognized by Government of Andhra Pradesh, affiliated to Andhra University Visakhapatnam. Sanketika Vidya Parishad Engineering College is accredited by NAC with A grade in the year 2024. Now, regarding this, regarding today's session, our A. Veera Brahma Rao Garu is the speaker today, and who is a postgraduate in commerce, MBA in finance, postgraduate diploma in securities law, and postgraduate diploma in alternate dispute resolution. Shri Veera Brahma Rao Garu has got over 33 years general manager experience from State Bank of India after serving for more than 33 years in various activities in the bank. Thereafter, as CEO, Trust Exchange Company Doha, Qatar for 4 years on deputation from SBI, that is from 2005 to 2009. Shri Veera had exposure in diverse field of banking during my stint with SBI for over 33 years as financial professional. Chaired the meetings of Zonal Office Credit Committee, ZCC, for high value credit and stressed asset resolution. Deputed by the bank as CEO of Trust Exchange Company Doha, Qatar, initiated and implemented Government of India's direct benefit transfer scheme in the state Odisha during 2010 and 11. Steered the growth of agri and rural business for SBI. Worked in SBI Central Board Secretariat, Apex Policy Making Body of the bank, and conducted Central Board as well as other board meetings at the stipulated intervals. Worked as nominee director in Utkal Gramya Bank, Odisha, and Odisha State Warehousing Corporation. In 2025, he has joined Association of Mutual Funds in India, an apex body of mutual funds in India, as a senior consultant for spreading investor awareness in southern part of the country. Now, over to you, Sabja sir. Thank you.
Yeah, Mr. Sabja, could I proceed?
Yes, sir. Please.
Yeah. Thank you, Mr. Kiran, for your nice introduction. Thank you very much for the management of the SVP Engineering College affiliated to Andhra University, Visakhapatnam, for hosting.
Welcome, sir.
For hosting this investors awareness program. And this program is being launched, conducted by AMFI in collaboration with SEBI, the Securities Exchange Board of India, to create awareness, particularly about the mutual funds and their benefits. Can we proceed into the presentation? Sabjatji?
Yes, sir. Please, sir. Please, sir.
A presentation, please.
Yes, sir. Please. Yes, sir. Thank you.
Yeah. Mr. Sabja, please, your presentation is not visible. Hello.
Yes, sir. Slides are visible, sir. Kindly proceed, sir.
Okay. This investor awareness program is all about uh, this, basically what we are, trying to highlight is trying to
Hello,
highlight.
sir. Hello.
Yeah.
Yes, sir. Please.
Yeah. I'm
Sir,
I'm
please
trying
start.
to,
Yes.
because your the slides are not coming properly. That is what I'm worried about. The slides are okay with you. For me,
Sir, PPT
yeah.
is
Now it is
displaying here, sir.
okay. Yeah.
Sir,
So let us
PPT is displaying.
yeah. So anybody when they are earning money, so generally any individual or a business person, they will do three things. First of all, they spend most of it, and part of it they will save, and part of it they will invest. This is what we will do with the earnings that we make from our monthly or quarterly income that is being generated either from salary or from the businesses. Next. So in this connection, let us try to highlight the Warren Buffett's famous quote in this regard. What he says, he is, I am sure somebody is, creating problems, sir. What is this, scratches are coming on the screen. Please don't do that, sir. Hello. So when somebody, when once somebody wants to invest or save, they have to take into consideration the inflationary conditions in the economy too. Without taking into account the inflationary conditions, your savings and investments will get deeply impacted by this. You may thought that you have saved a full apple, but unfortunately, the part of it will go in towards meeting the inflationary conditions in the economy. So you have to always, any investor has to take this aspect into consideration while investing. Next. So how the the impact of inflation on our expenses and savings? Let us see. The slide depicts expenses today. If you want to lead a decent standard of living, maybe as a starter in the life journey, you may require 30,000 rupees. So as you grow, as you travel in your life journey, so the aspirations will go. But even without taking that aspirations into consideration, even if you want to lead the same standard of living, even after 5 years, without any additions, without any new needs or this thing, you may have to spend 40,000 rupees. That is that 10,000 is the impact of the inflation. So one has to take this aspect into consideration while talking about their expenses. Similarly, the savings aspect. Savings also, you thought that you might have saved 1 lakh rupees today, but the value of it, the purchasing power will decrease that the value of that savings to over 80,000 rupees after 5 years. And it gradually keeps on decreasing as far as your savings are concerned. At the same time, it keeps on increasing as far as your expenses are concerned. This fact you have to take into account while saving or investing. Next. Yeah, solution. What is the solution? Having said that, the inflationary conditions will impact our savings and investments. What will be the solution for this? Investing and the safeguard against inflationary conditions. That means you have to start from day one. Start saving the earlier you start, the better. Then progress from savings to investment. Keeping idle in a locker or under pillow or even in savings bank account doesn't yield much of any return for you. You have to progress from saving to investing. Put money to work. You have to always ensure that whatever you have saved, whatever you have invested, has to work for you, not that it has to be kept idle. So you work hard to earn your money. Similarly, that money which you have saved should also work for you as a second source of income to supplement your the regular source of income what is assured. Next, last important aspect is compounding impact. Compounding means taking into account the interest on interest, that is benefit from the compounding impact. Uh, for this, to achieve this solution, you should have a comprehensive financial plan at your hand. Next, yeah, what is financial planning? You said that to achieve that, you have to have a comprehensive financial plan. What is that financial plan? First, define your financial goals. The first and foremost important step is define your financial goals. Uh, and then assess your current source of income. What is the income that is available to me to achieve already defined some financial goals? Then create an asset allocation for the investments and savings that you have done. Then invest accordingly. And you should not deviate unnecessarily. You have to very strictly. Financial discipline is most important thing to achieve this. And don't, once you invest and don't keep it, forget about it. Okay, I have invested, I have saved. No, you have to keep on monitoring how that investment and saving is performing, whether that is yielding desired returns to achieve your financial goals. This is called comprehensive financial planning. Next, why this financial planning is important? To reach your financial goals faster and in a disciplined manner. And to enhance, nobody wants to be in the same standard of living throughout their life journey. Everybody wants to, achieve a better standard of living for themselves and for their family members, and to be recognized in the society because of their standard of living, etc. So to enhance that standard of living, a proper and studious financial planning is very, very important. And third important aspect is emergencies. The financial emergencies, nobody can anticipate them. Like, sudden, some medical emergency, some, maybe a death in the family, maybe, functions, something has to cropped up from nowhere. So you have to have that cushion to meet this type of exigencies and emergencies to meet. And also, when you are earning money, you have to, the government will not keep quiet. They will also impose some taxes. To have an effective tax planning, you should have this very disciplined financial planning. And finally, if you do all these things, what happens? You will have a peace of mind at the end of the day. You need not worry for all the jerks and unforeseen circumstances that may come up in your your life journey. Next. Yeah, again, coming back to the Warren Buffett's famous quote is, don't never depend on one source of income. You have to have a second source of income through your investments. Your investments should create a second source of income for you. Why? To increase the standard of living, to enhance it, to meet the exigencies, emergencies, to have a proper tax planning, and finally peace of mind. The second source of income is very, very important. Next. Investing in the right asset can help create a wealth in the long run. See, finally, when you are investing and savings, we said that don't keep it idle. You have to invest it properly in a proper manner and in proper area, so that it will yield you as a second source of income. This Sensex, the stock market is one source of avenue for you to invest. So if you look at the screen, the returns that are being generated over a period of years uh, by the Sensex is a very decent returns. The lowest you got it 10.4% net of tax, whereas the highest will be is anywhere between 16.8%. This is the returns that you generally get when you invest in proper shares, stocks, and bonds. For that, you should have an expertise. You just cannot just enter and try to take benefit out of it. You have to have expertise to have to make investments in the stock markets. Next, the same, whatever the earlier slide was there, this one is also in the graphical form it was given. Generally, the Sensex has a tendency to generate revenues, to generate incomes over a period of except a few dips. If you look at it in the year 2009 and 2019 or 20, generally the tendency of the Sensex is keeps on growing uh, at a what you call healthier pace. So, but as I said, you should have some expertise in to identify the proper shares. And if you are, as long as you're an investor in the share market, you will get this type of returns. But if you speculate, I think we cannot talking about speculation in this investment awareness program. We are only talking about investors awareness program. So be careful when you are investing in stock markets. Next. Determine what you're investing for. See, we have already financial goals. Define your financial goals. In the earlier slides, we talked about our financial goals. These financial goals it's like this. You have to have, it's depicted in the form of a plant where, when you are single, it's okay. But then when you have a family, children, everything is, you have to meet their expenses, additional expenses. And to meet the family's requirements, you may require a four-wheeler. From two-wheeler to four-wheeler, you have to increase your standard of living. Similarly, with family, you can always plan for trips for their uh, enjoyment and the children's education, and to have a home is everybody's dream generally in India, to have their own house. So all these things, to achieve this, and finally retirement. Final retirement, peace of mind with to meet all these things. You have to have a proper and a disciplined financial planning. Next. Next, please. Yeah. What are the options available for us for investments? You have real estate. The traditional source of investments are gold, real estate, stocks, insurance, bonds, and bank deposits. These are the generally, we are all aware of this. Besides this, the traditional investment sources, we also have mutual funds as the one of the most important, um, source of asset class that is available for you for investments. Next. So, make your investments work for you. As we have said in the earlier this thing, don't keep idle your investments, and they should work for you as a second source of income. Why they should investment should work for you is there are five important conditions, or five important attributes which require your investment should work for you. What are they? You should fight the inflation and provide a second source of income, and easily accessible whenever you require, and accessible for your financial emergencies. And at the simultaneously, they should grow in value and appreciate over time, and realizable, and very at a very low cost, and immediately whenever you require that. So what is the answer for this? Proper asset allocation is the answer for your investments. Next. Yeah, your asset allocation your financial planning, which is to be a proper required proper asset allocations, and that asset allocation should be like this, like a thali. This is like a balanced thali. You will in a thali you will find several items for which to your liking, and whatever you require you can take, and your investments also should represent like a thali. Next. Yeah. So if you look at the traditional investments, some of the investments areas, asset classes that will grow in value, they don't give you any returns, regular returns. Like in property, today maybe a lakh of rupees you have invested in a property. Maybe after 5 years it will go up to one lakh 25,000 or 1,50,000. But regularly it will not give you any return. Only after 5 years, if you want to sell it, you may fetch it 1,50,000. Similarly, gold and other uh, equity shares and others, they don't give you a regular return. But they grow in value if you invest properly. Similarly, on the right side, if you see that some of the investments are generally what you call they will give you returns, but they don't grow in value. If you say a lakh of rupees, if you keep it in a fixed deposit, say 7% or 8% return, interest rate they will give you, but your 1 lakh will be intact, no appreciation in that. But in between these two asset classes, you have mutual funds. Not only they grow in value, but also give you your options. So, success or not. Next. Next. Yeah, please. Next, please. Next slide. Yeah. Hello.
Yes, sir. Please. There are participants due to some technical issue, and we will wait 1 or 2 minutes. Today's speaker, Mr. Brahma Rao, sir, he will join within 1 or 2 minutes.
Yeah.
Okay.
Yeah. I'm online. Is it okay now?
Yes, sir. Okay. Please.
Yeah. What then when we said that in between there is a mutual fund which has both the characteristics of growth in value as well as growth in regular returns. So then let us discuss about what is a mutual fund. A mutual fund, as its name suggests, is a financial vehicles that collects money from various investors and invest them in securities such as stocks, bonds, and debentures. Anybody can enter into mutual fund schemes who has investable surplus with them. Uh, it is the most cost efficient because you don't require to spend so much money to go into this, unlike in property deals and other things where registration costs and all other costs will be there. Here there will not be any additional cost. Just you can invest your entire money and get returns on the entire money. And mutual funds are managed by expert fund managers who knew what to do and where to invest and how to invest. And on behalf of the investors, the fund manager will be sourcing the investments and in securities and bonds. So his expertise, you can depend on that. And only one rider is the mutual fund investments only gives you market returns, not assured returns, unlike in bank deposits. Bank deposit, that 7% is assured, but that your principal will never grow. The principal will be like that only. The characteristics, it will only thing is it will give you only in market returns. Next, and as we have seen in the Sensex slides, where two slides were shown you in the long run, the Sensex has a tendency to give you better returns than the assured returns. Then when we talk about mutual fund, let us see how the mutual fund works for the investors. Say on the top, end, you see the investors. There are pool of investors, and these investors pool their money, put it in the hands of a fund manager, and who is an expert in investment in investing in stock markets and bonds, and that fellow will invest on behalf of the investors in stocks and securities, and to generate higher, much better returns than the assured return market. And those returns that are generated by this fund manager will be distributed to the investors net of expenses. This is how the mutual fund work. Next. Yeah. So why invest in mutual funds? Because there are very, easy to enter, low cost, convenient. You can even within 1,000 rupees also you can join the scheme. And there is a professional management in the form of a fund manager. Because he is an expert in that area, the risk diversification will be there. The fund manager will never keep all the investments in one stock or bond. So he keeps on, diversifying the portfolio and looking for opportunities where he will get better returns, and accordingly the risk will be diversified. And most important thing is this industry, mutual fund industry, is well regulated by Securities Exchange Board of India, who is like, for banks, there is RBI, for mutual fund industry and stock markets, there is a regulator called SEBI, and very strict regulator. The SEBI will monitor the functioning of all the mutual funds in the market. And because the SEBI is regulating the market, there will be a lot of transparency in the operation of the schemes, and SEBI forces the mutual fund industry to disclose various information to the investors, so that there will not be any tomorrow the investor should not say, I am not aware of this thing. And finally, the liquidity, easy liquidity. You can liquidate your funds very easily, because if you apply in in a redemption form in the next 2 or 3 days, the amount will be credited to your account. Next, please. Yeah, let us see in going deep into the mutual fund this thing. Let us see how it is structured and what are the schemes that are available for us. The structure is like this. There will be a sponsor who wants to start a mutual fund company, and that sponsor should not directly start that. First, they have to appoint a board of governors and trustees, and the trustees in turn float an asset management company, because there should be a hands-off approach between the sponsor and the asset management company. The sponsor should not have any control on the asset management company. The asset management company is run by the board of trustees, who were appointed by the sponsor. And this asset management company will pool the resources. They design schemes for the investors, various types of investors, and through a fund manager, and they will invest in shares and bonds and securities market, these pulled up resources, and these there will be a registrar and transfer agent for all the units, for the investors to be, again, a hands-off approach. And there will be a fund manager, fund accountants, bankers, and agents who will pull up the resources from various distributors, these from the investors, and giving it to the hands of the fund manager, who will invest. And whatever securities and bonds that was purchased by the fund manager has to be kept with a third party, again a custodian, and the asset management company also do not have any access to those things unless there is a proper verification by the custodian. So this is how the operations are structured, so that no one person or no one sponsor or company can take advantage of the investors' money. So this arm's length distance is being maintained from each of the stakeholders in the mutual fund company. Next, please. Yeah, there are types of mutual funds after taking note of the structure. Let us also understand the mutual fund types. There are 5 types based on organizational structure, management portfolio, investment objective, investment portfolio, and other types of funds. These are various schemes are available based on these 5 broad categories. Next. A categorization of mutual funds. After seeing the types, let us categorize. The schemes are categorized into 5, again, broad categories, schemes. One is equity schemes, second one is debt schemes, hybrid schemes, solution-oriented schemes, and other schemes. As the name suggests, we go each one into a slightly more in detail so that you will come to know what exactly does it mean, what is equity scheme, what is debt scheme. Let us see. Next. Now, what are the equity schemes? The equity fund schemes are nothing but most of the funds collected under these schemes are invested in equities and equity related instruments of the companies. And what is the objective? See growth in the long term and can be volatile in the short term. And who are the investors who can contribute to this? These schemes, equity schemes, are suitable for investors with higher risk appetite and long-term investment horizon. This is the characteristics. What type of investors can look for this type of schemes. Next. Equity fund categories are again, there are very in a multifarious categories are there, like multi-cap, large and mid-cap, small cap, and flexi cap. What is cap? Cap means capitalization. Capitalization means the value of the shares of a company in the market, how the Sensex is viewing it. Say the value of the face value of a share may be 10 rupees, but the value of that 10 rupees share in the market may be 100 rupees or 200 rupees. That is capitalization. The market capitalization is like that. See, similarly, the schemes that are being designed under equity fund are categorized into multi-cap, mid-cap, large cap, etc., depending on the capitalization of the companies. Next. And another type of category which we can look into in equity is dividend yield fund. And regularly the dividend will be, the investments will be made in the dividend yielding companies only. Value fund, value investment strategy is, growth companies. Even though they are not paying any, dividend, the companies must be having huge growth potential. That type of companies, the value investment strategy will work. In the contra scheme follows contrarian approach strategy with at least 65% in stocks. Contrarian approach means what? A different approach. Every market is looking at one way. This fund wants to take a different perspective and a different turn and invest in other types of companies which are not being chased by other investors. A focused fund, thematic fund. The last one is very important, ELSS. ELSS means equity linked savings schemes. Equity linked savings means 80% in stocks in accordance with the equity linked savings scheme. Upcoming companies, all these companies, startup companies, if they will be, ELSS scheme will define that, and this will give you tax benefits, tax rebates up to 1,50,000 rupees. Tax rebate will be given if you are investing in ELSS scheme. Only thing is, the rider here is the investments that are being made under that scheme is there is a lock-in period of 3 years. You cannot touch your investments. That is the only rider, but it has a lot of growth potential because They are investing in the startups and other things which are having high growth potential. Next. Yeah, same thing that ELSS scheme is explained in detail. Tax deduction from taxable income up to 1,50,000. Investments predominantly in equity and health. What you call generate market linked returns, and lock-in period is also there for 3 years as compared to the other tax saving schemes. Next. So having dealt with the equity schemes, let us see how the debt schemes work. And the debt funds is generally aimed at the investors with low to moderate, risk appetite people, investors. That means they don't want to take higher risk, like unlike in equity schemes. Here they want to play safe. So that type of category of investors can choose debt funds, where they invest in different types of fixed income securities, aim to earn interest income and capital appreciation, suitable for investors seeking returns with low to moderate risk. Next. Yeah, debt funds also was given in a metric format where the risk on y-axis and an x-axis duration and maturity period is given. So, which are the funds which are having uh, maturity is high and risk is high? What are the schemes that are available? Credit risk fund. All these funds are on high risk and high maturity. So similarly, several schemes are being designed to suit the requirements of the appetite of various types of investors with low to moderate risk appetite. So let us go deep into that. Next. The debt fund categories are, is again very suitable for having liquid surpluses for shorter duration periods. Even if you look at the overnight fund, this is even one for one day also you can park your funds in this fund, get something out of it. Liquid fund is the second category, liquid fund up to 91 days. Then the third category is 3 to 6 months. Similarly, these are all the various types of funds spanning from 1 day to 7 years. You can plan your investment strategy, and depending on your financial goals, you can choose your fund that is suitable for your requirements. Next. Again, another type of category in the debt fund category is long duration fund, dynamic fund. All these things, these are all, again, the idea is only catering to the requirements of the low to moderate risk appetite investors. But the schemes are so designed in such a way that it will cater to the various objectives, financial goals of the risk-averse investors, and to meet their requirements, several schemes are being designed to meet their requirements. Next. Yeah, hybrid schemes is nothing but it's a combination of equity and debt. Equity deals with only almost 80 to 90% of the investments will go into equity funds only. Debt schemes means only 80 to 90% will go into debt schemes only. Whereas hybrid means it's a combination of equity and debt, and it's a mix of equity and debt, and aims to generate wealth from equity exposure, while the debt portion will gives you a standardized and return to the investors, suitable for investors looking for a mix of safety of income and modest capital appreciation. This is the investor category which the fund is aiming for, hybrid fund. Next. Hybrid funds are also various categories are there, various types are there. One is a conservative hybrid fund. Then conservative hybrid fund in 10 to 25% investments in equity and equity related instruments. 75 to 90% in debt instrument. It's a hybrid, no, it's a mix of both. Then balanced hybrid fund means 40 to 60%. Similarly, various investment objects, various patterns were given whichever suits your, risk appetite, you can choose your scheme. Next. Yeah. The fourth one is solution-oriented schemes. What are the solution-oriented schemes? Let us go into them. Next. These are all solution-oriented retirement funds, children education fund, fund of funds, index funds. These are all the various solution-oriented schemes. Retirement fund means, as the name suggests, that you invest in this type of funds, seeking a decent return by the time you are retired from your service, so that you should not, deprived of the income source which you are getting as a regular income, as a salary or a business income. This, if you invest in this type of a solution-oriented scheme, it will give you at the time of your retirement a decent return and also a lump sum amount by way of a capital. So similarly, children education funds also, when you start your life journey and your family, and when there are additions to your family, you can keep on investing in this type of schemes, which commensurate with your children's educational requirements when they go to college and other, higher degree schools. So similarly, index funds are, uh, index is, yours. Index means nothing but BSE, Bombay Stock Exchange, NSE, National Stock Exchange. These are all, the the Sensex is being decided by a basket of shares, which are, a company shares and other things. So when index funds, they track only those shares which determine the index. Similarly, fund of funds, overseas domestic funds, where minimum 95% investment in securities of a particular index. This is called fund of funds. So these are these are the solution oriented schemes for the investors who wants to a peaceful retirement or children's education at a later stage. Next, index funds, same thing. What we have, portfolio reflects the index, that is BSE Sensex or National Stock Exchange, aims to provide returns in line with the index. Whatever the index is giving returns, maybe we have seen that graph, and also the Sensex performance over at 35 years period. So it's a decent minimum return 10.5 and the maximum is 16.8%. The Sensex has given generally when index funds are, if you want to index or invest in index funds, you will also get similar type of returns which are being generated as per the index. Next. Index funds, same thing is given in a different, characteristics are defined here. Mirrors a market index, includes securities as per index, and in the same proportion or weightage. Passive fund management. Here, the fund manager do not seek any expertise because the index is tracking. So automatically the index tracks only good, this thing, in shares. So not much of an expertise is required. And also the expenses will be much less than compared to other schemes where the churning is much more and frequent. Here, the churning will be, because it's only a Sensex based stocks and shares, the expenses will be less. Complete transparency in knowing the stocks in the portfolio, because index fund means whatever the index is being determined by the shares, the same shares are being used for your investments. So there is not much of a hidden agenda in this. Totally transparent schemes are available under this scheme. Next. Next, please. Yeah. Exchange traded funds also similar to that. Passive fund management tracks an index, a commodity, bonds or basket of assets, trades like a common stock on the stock exchange, like, shares and bonds, and lower cost of fund management is again a passive fund management. Not much of an expertise is required in this type of exchange traded funds. Next, gold exchange traded funds also. Here, the investment objective is to invest either in pure bullion or gold-related instruments approved by SEBI and gold deposit schemes of banks up to 20% of its net assets. Say each unit of gold ETF represents a defined weight in gold, typically 1 gram. The price of gold ETF unit moves in line with the domestic price of the gold. Gold ETFs are benchmarked against the prices of the gold. Consider this is very important because long-term capital gains benefits if held for 3 years and wealth tax is applicable on units of gold ETF because it's a bullion. Next, please. International funds. International funds is this is another category of funds where the investments will be made in the ADRs and GDRs of the Indian companies. What are ADRs and GDRs? The Indian companies, which are the shares which are denominated in rupees, cannot directly trade in the international stock markets. So what the companies, reputed companies will do is they issue American deposit. ADR means American deposit receipt. GDR means global depository receipts. As a security of Indian shares. So these, American depository receipts are denominated in dollars, whereas GDRs are denominated in the currencies which are, either in, pounds or euro or Japanese yen, etc. So these funds, they will invest in those ADRs and GDRs, and the returns that are being given to the international investors are being shared, because they are investing in the ADRs and GDRs. This some portion of it also will be invested in Indian equity, but not entirely only in ADRs and GDRs, but very, very little portion also to offset, immediate requirement of the investors. Some portion of it also will be invested in the Indian stock markets. Next. Fund of funds is again another category of fund where the fund manager will invest in other mutual fund schemes. So he don't invest in shares and bonds and directly. The fund manager will go and invest in the other mutual fund schemes like State Bank mutual fund. If fund of fund scheme is there, this fund manager will go and invest in either in HDFC or Kotak Mahindra or Morgan Stanley fund schemes which are doing very well. So here also the fund management is very, very passive because he is only investing in the other fund schemes. But for the investor side, if you look at it, the expertise of two fund managers is available to the investor, where your own fund manager who will identify the performing schemes of other mutual funds, and that fund manager who is in turn investing in the stock market and shares and giving good returns for their investors. So you will have the expertise of two fund managers, and again it's a passive fund management. Next. Next, please. Yeah. See, arbitrage funds, arbitrage is nothing but taking advantage of the differential in pricing between two market conditions. So you buy in one market which is trading low and sell it in this another market where the price of it is still quoted at a higher value. So the differential, you want to take advantage of it. This is called arbitrage funds. So this practice of buying a security in one market and then selling it at a higher price in another market. So this is, these are the various methods of doing it, but the investors can benefit from a volatile market without taking on too much risks if you go for this type of arbitrage funds. Next. Mutual fund schemes, which one to buy? is the question. Okay, having understood the 5 schemes like equity, debt, hybrid, solution-oriented, and index-traded funds, which one to buy? Again, mutual fund is nothing but a risk and return trade-off. Any investment is a risk and return. The higher the risk, the return will also be higher, but the risk is also very high. Similarly, moderate risk and moderate returns, low risk and low returns. Similarly, it's which one to buy is depending on your risk appetite and your risk taking capability of the investor. You can choose the scheme that suits you. Next. Yeah, having studied various types of schemes and various categories under each of the types, uh, see how to go into mutual fund investments. What are the important documents one has to look at it before investments? First is the scheme information document. Scheme information document will give you a comprehensive information on the scheme and where they are going to invest, the funds sourced, and who are the fund managers. Different detailed, information is given in that. One has to study that before you make an investment decision where to invest. Second one is a statement of additional information, SAI. It gives you, helps you in tax planning. What are the tax and legal implications if you invest in that? Scheme is given in this second one. Third one is KIM. KIM is nothing but is a shortened version of SID, Scheme Information Document. Here, because nobody has time to go through the comprehensive document and try to understand what all the nitty-gritty that is given in that scheme. Instead of that, a prudent investor can go into KIM in detail, and which is the shortened version of SID. Next. Again, another important aspect which that is mandated by this by SEBI this industry is fact sheet. Every month, the company has to issue on each of their schemes how the scheme is performing, what are its investment objectives, and where they have invested, how much return it is getting, what is the risk that is carrying at that present moment. All the details are being given in the fact sheet, and this has to be issued per scheme, each of the schemes of the mutual fund every month. This is a very, very important information document for the investors, which gives you the performance of your scheme. Next. And how to invest? There are 2 types of plans here. One is a regular plan and the other one is a direct plan. Regular plan is you have to, you can invest through the help of a mutual fund distributor or an agent. And here the NAV is slightly, because the third party is involved in your investment, an agent and distributor who has to get some commission on your, on the pooled up resources. So the NAV is slightly less when compared with the direct plan. The expenses are also will be more here because the NAV will be, because of that expenses are more, the NAV will be slightly less. In a direct plan, what happens? You go directly into the internet website of that mutual fund company and choose your scheme which is suitable for you. Then accordingly you invest. Here the expenses involved are very minimal, nothing is there. So you will get higher NAV and higher expenses will be less. So direct plan is always good in case if you are well versed with the internet banking type of things. Next. So here again, there are 2 options that are available for the investors. One is a growth option and the second one is the IDCW option, that is dividend option. Growth option means the returns that are being generated in the scheme are being reinvested in the scheme itself, so that the compounding effect, what we have said in the beginning, you will be taken advantage of it. And And the dividend option is the investment will be intact, and you can opt for dividend option, so that quarterly or half yearly or whatever dividends will be uh, paid back to you, including, if you want, as part of the capital also can be given to the investors. Next, modes of investments. How to invest in the scheme? You can put a lump sum, a lakh of rupees, like a fixed deposit, or you can take advantage of systematic investment plan, where regularly on like a bank recurring deposit scheme, you can choose this systematic investment plan, and regularly you can invest in that by way of SIP. And a systematic transfer plan, and here, transferring a certain amount from one mutual fund scheme, you have invested a lump sum, and there are some returns in that. You can, instead of taking back the returns, you can opt for STP, and those returns can be invested in another scheme where you will get going to get better returns. And inter scheme switches also is possible within the mutual fund company itself. If you want to say, if you're invested in SBI mutual fund, one scheme, and that scheme is not up to your satisfaction, the returns that are being generated, you can opt for another scheme in the same SBI mutual fund from the what you call your investment can be transferred. You can ask for transfer of an investment into the another scheme which is doing much better than this type of scheme. So this type of options that are available for you as an investor. Next, the systematic investment plan, which we have already covered, is like a bank's recurring deposit scheme. Every month or at a frequent predefined intervals, you can invest even with a small amount like 1,000 rupees. Whatever liquid surplus you're having, you can keep on investing in that through SIP. That is the beauty of systematic investment plan. So it is averaging, it helps you to average the cost of units, and you can invest in smaller amounts, and no need to time the market, because you are keep on investing in over a period of time. You need not worry how the market is faring, and etc etc. Yeah, next. The power of compounding is available to you in the SIP. That is, suppose under SIP, if you have given an instruction 1,000 rupees per month at 8% per annum till the age of 60, if you invest, what happened? If you start investing at the age of 25, you must have saved or invested only 4,20,000 rupees. When you attain 60 years of age, the corpus that you are going to get out of this thing is 23 lakhs plus. So this is how the compounding impact will be given to the passed on to the investors. Similarly, at various age profiles, if you start investing in the same 1,000 rupees, and you will get this type of returns. So the sooner, that's why always we said start early. The sooner you start makes a lot of difference. Next. How this SIP will average your costs is given in this as graph. In the rising markets, falling markets, and volatile markets, if you look at it, in all the three market conditions, if you opt for a SIP type of a systematic investment plan, your average purchase price is much better than the regular price, and your average cost per unit is also slightly averaged out, and you will get much better NAV and average cost for your investments. So the above what is that? Rupee cost averaging, discipline is the key, and control volatility. These are the three attributes that you will get when you start investing through SIP. Next. Systematic withdrawal form also, withdrawal plan is also available to you. It allows an investor to regularly withdraw a fixed amount from their mutual fund investment. This is very important. This scheme, in case if you require funds at regular intervals. You can you can choose this scheme systematic with the, okay, every quarter I want this much money from my investment or and returns. So until portion of capital, portion of returns will be returned to the this thing through this systematic withdrawal plan. Next, how to invest in mutual funds. Again, we have seen that direct and regular plan is there. To enter into that through those two schemes, what are the prerequisites? KYC is very important. KYC means you are all aware, know your customer type. You have to identity proof, address proof has to be submitted. This will be vetted by a centralized agency, and once it is approved, your KYC is approved, you can start investing in the mutual fund industry. Unlike in any other, for every bank, you have to complete the formalities. If you want to open you want to open an account with SBI, you have to complete KYC here. And then tomorrow, if you want to, open an account with the HDFC or some other bank, you have to complete KYC there also. But unlike here, for the mutual fund industry, total industry itself, if you complete the formalities, because there is a central database, you can, once your KYC is approved by the central database and uploaded there, you can start investing in any mutual fund scheme at your will. Next. And KYC is, why it is important is given here. It is, agents are there. They will do the needful. They will vet your KYC. Just to, because, nowadays money laundering is the most, after repeated, we are hearing about money laundering. To obviate all these things, this KYC is made very, very stringent and strict when you start investing in mutual funds. Next. Modes of investment, as we said, physical mode and online mode. Physical mode is like a regular mode, and online mode is, direct mode. This is called, like internet banking. You can go and directly invest in the market. Physical mode is through agent and the bankers or the distributing agents, etc. You can do that. Next. Offline and physical mode, again, the distinctions are given. Here, as we already said, online mode, the NAV is slightly higher because the expenses are not there much for the distributors and agents. You can get better NAV. Whereas here, offline mode, because there is an agent that is involved, then the mutual fund company has to pay commission on your pulled up resources. So your NAV will be slightly lesser, but expenses are also slightly higher. So that is, you can choose as per your operational convenience and our expertise in technology. Next. How to withdraw your money. Again, the same two modes are there, offline and online. And offline is you have to submit a redemption form to the agent, transfer agent and other things. So, and once it is submitted, received by the company, mutual fund company, in the next 2-3 days, your redemption will be carried out and amount will be credited to your account. Similarly, online mode here is much slightly faster. You can online go and log into the online transaction mode and fill up the form and the redemption form and then submit it online, and slightly in a faster mode you will get it. Next. There are performance evaluation principles are also available to all the mutual fund investors. A mutual fund provides relative return with respect to its benchmark. Each scheme is benchmarked, against a certain return, and this evaluation will be done based on the benchmark, and also the period of holding also is taken into consideration, and the risk a fund undertakes under the returns generated by taking this risk should be proportionate. You should understand what is the type of risk you anticipated and what is the type of risk the scheme is running now, and accordingly you can take that monitor and review. In the first stage itself, we have talked about it. Next. Stress testing is also available. What is, stress testing means scenario building. under various market conditions, how your mutual fund will perform will be stress testing also will be done, and accordingly the investors will be given a roadmap how in these conditions the mutual fund may perform this way, and in case of volatile conditions, in case of rising markets, in case of downturn markets, how your fund will perform is given in this stress testing. Next, NAV. This is the in mutual fund. When you are familiar with mutual fund industry, without NAV, you don't get anything out of it. NAV means net asset value. What is net asset value? The net asset value of your investments. Today, you have invested ₹1,00,000 in mutual fund. Maybe after 1 year, what will be the investment value? Will be how it will be determined based on the net asset value. It means what are the shares and bonds that are being invested from the resources pulled up in the scheme minus expenses divided by the number of units that have been uh, issued to the investors. This is how the net asset value will be arrived, and this net asset value for each of the schemes of all the mutual fund companies is available in our website, AMFI's website, and anybody how your scheme is performing, what is it net asset value, what is the value of your investments made in that scheme. Next. Yeah, product labeling is also there. For every scheme, this has to be very, very this product labeling is very important. Riskometer. This is called riskometer. Each scheme has to be given this risk rating by way of riskometer. What is the risk that the scheme is running? Low risk, low to moderate, or moderate to high. All these things will be given in the product labeling by way of riskometer. When the scheme is launched, this riskometer is also will tell you what type of risk that scheme is running. It's very, very important product labeling. This portion has to be understood by each one of us. Next. Nomination facility, we are all aware like KYC nomination is to go hand in hand. When you are entering into a scheme, you have to nominate, give a nomination. In the event of unfortunate, some circumstances, your units will be transmitted to the people you named in the nomination form, and easy way of settlement in case of unfortunate event, and this will help in transmission of shares, units into the names of the nominees. Next. Why is nomination important? We're all aware of it. Easy transmission in case of an unfortunate event. Instead of struggling to get the transmission done by way of submitting several documents, this will be done when the nomination is given. Just you submit the nominees have to submit their ID and address proof and other things. Their identification has to be proved. That's all. Nothing more than that. And it will be transmitted without asking any questions. That is why nomination is very important. Even nowadays, banks are also asking for all the accounts, nomination is made mandatory. So for mutual fund industry also, nomination is mandatory. Next. Complaints redressal mechanism. We are having talked about the investments, various schemes, etc. In case if you have any problem in redeeming your investments or having some issues, whatever complaint you have, you can there is a robust redressal, complaint redressal mechanism is put in place, mandated by SEBI, and all the companies have to put in place the name of the redressal officer, his cell phone number, whom to contact. Everything will be given upfront. The investors can directly lodge a complaint with him, and so that the complaint will be redeemed very fast. Next. Similarly, SEBI, the regulator, also has a complaint redressal mechanism called SCORES, SEBI complaint redressal system on online only. This is possible. You can log into that system. In case if a complaint is not redeemed by, redressed by this mutual fund company, you can lodge a complaint with the SEBI underscores, and it will be redeemed, redressed very fast without much of a waiting period. Next. And SEBI to help the investors and do financial education and to make awareness of the financial literacy and investors awareness programs. They have launched a app called Sarthi app, and which is very helpful to the investors to know what are their avenues available, how to invest, and how to withdraw. All these things are given in this. It's a wealth of knowledge this Sarthi app gives you, and you can rest assured by going into that app and know fully about schemes and opportunities available to you. With this, I stop here. Thank you. Next slide is only thank you slide. And if you have any questions, sir, whatever topics we have covered, I'm ready to answer. Thank you very much for your patient hearing.
Dear participants, if any questions, please write your questions in chat box, please. Or if any interested to ask any question directly to speaker, please raise your hand so we can unmute, please. Dr. R.S. Kiran, sir. Sir, please unmute your ID option, sir. Please, sir. R.S. Kiran, sir. Yes,
Questions
yes.
that have been sent to me.
Okay,
So,
please.
students are asking about the growth rate of the mutual funds in India as compared to abroad.
The growth rate is, because, compared to the, mutual fund industry in the advanced countries, ours is slightly, I think we started a bit late, because they have already achieved the higher growth rates in the developed countries. Whereas here, the growth rate nowadays, if you look at it, there is a substantial awareness that has been generated by SEBI as well as AMFI for mutual fund industry. If you look at the growth rate compared to the last 4-5 years, the mutual fund industry has grown substantially. Nowadays, compared to the maybe 5 years back, and now the growth rate is 141% has achieved, and substantial growth rate. And people are, nowadays, instead of going into the stock markets, they are trying to go for at least partially. It has been accepted and very much validated as an asset class, who can, for which can be looked for the investors having a moderate to higher risk appetite. Yeah. Next, sir. Any questions,
Yes,
sir?
There is another question also from one of the participants.
Sir.
They would like to know about the risk factors that are involved in investing upon the mutual funds.
Sir, risk factor, as I said in the beginning itself, it is mutual fund will give you, because they're also investing in the stocks and shares of BSE and NSE. What happens? You will get only market-related returns, not assured returns, unlike in a bank fixed deposit and other company deposits, etc. Here, there is no assured return. It is market-related returns. If you recall the slides, what we have shown you, the performance of Sensex, graphically also we have given for a period of 25 to 35 years, and every year except, slight dip in, very except one in 2 years. 2009 and 2000 maybe 20, always the Sensex is giving you a decent return. The lowest return that was given in the stocks and shares market is 10.6, whereas the maximum return that was generated by the Sensex investments is 16.8%. So if you look at the returns, I think it is much above the assured return schemes that are available in the market, like NSCs, PPF, or bank deposit schemes. Uh, uh, but only thing is, yes, no scheme can give you what you call issued returns under mutual funds. It is only market related returns. You have to be careful about that. Next.
Sir, one question in chat box. So now I am age 46. Till now, I did not invested in mutual funds. Now I am planning for it. So please advise me how long I can invest in term of SIP.
How long?
Sir, how long I can invest in terms of SIP?
SIP.
Yes, SIP.
SIP is systematic investment plan. That means, you can invest every month, by way of this, like a bank recurring deposit, you can decide the investment, how much you can spare every month, and the scheme you can select, and through SIP, you can invest in the mutual fund industry, because if you look at your retirement age at 60, you have a time, gap of 14 years. If you are at the age of 46, 14 years, you can, keep on investing in mutual fund through by way of SIP. And you can look back after 14 or 15 years, then you will get decent returns uh, by way of, it depends again, are you opting for a growth scheme or a dividend option scheme? If you are opting for a growth scheme, you will get a very good lump sum, and which grows uh, at a decent return rate. So again, it's a market related return. Nobody can assure you on this. Mutual fund will never assure you the return, but only thing you an indicative approach how it performed in the past, and going forward you can expect the similar returns in the market. That much only we can say, sir. You have a window of 15 years, 46, if you are at 46. SIP is the best investment mode. Every month, without any burdening of a lump sum amount, you can keep on maybe 5,000 or 10,000 rupees. Keep aside, say a lakh, 1,20,000 rupees. If you keep 10,000 rupees per annum, and 120 into 16 years will be, you will get in a decent lump sum of 30 to 40 lakh rupees. If market conditions are stable and giving the similar returns as of now, you will get a decent, a lump sum at the time of your retirement, sir. This is what I can say.
Sir, one more question in chat box. If I have certain amount of money, then shall I got for SIP or lump sum in mutual fund?
Yeah. See, if you have a certain amount of money, you can straight away, by way of a lump sum amount, you can invest in mutual fund. SIP is a monthly regular investment that you want to make. That is systematic investment plan, as the name suggests. That means every month you are trying to invest this much money, type of like recurring deposit, where you choose your monthly amount you want to deposit in the recurring deposit. Similarly, SIP also, monthly how much you want to, you can deposit in the by way of SIP, you can choose. Lump sum means you can straight away invest in the scheme, and either in growth option or in IDCW option, and accordingly it will be either a compounding effect or withdrawal at frequent intervals will be given to you as per your option.
Sir, one more question in chat box. How much money is the minimum ideal amount to start investing in mutual fund?
There is no ideal amount to be quoted. Even I said that is small amounts, like mutual funds are meant for small investors too. So even with 1,000 rupees also you can start investing in your mutual fund. There is no need to have a big amount only to enter. Unlike bank deposit, some banks demand to open an account 10,000 rupees, 15,000 rupees. No, nothing of that sort. Even with 1,000 rupees, you can start investing in mutual fund schemes. That's the beauty of it.
Okay, sir. Thank you. Sir, Mr. R.S. Kiran, sir. Sir, any question of any participant or student faculty from your side, please?
I think that's fine, sir. So if you say okay, then we can wind up the session at this moment.
Okay.
Thank you,
Yes.
sir. Kiran sir, thank you very much for the wonderful.
So thank you, sir. And feeling gratitude and not expressing it is like wrapping a present and not giving it, as William Arthur said. So no duty is more urgent than that of returning thanks. So we thank you wholeheartedly for your wonderful and insightful session, sir. And I, on behalf of Entrepreneurship Development Cell and Institutions Innovation Council of Sanketika Vidya Parishad Engineering College Autonomous, Visakhapatnam, would like to thank the speaker of the day, Mr. A. Veera Brahma Rao Garu, and also thank AMFI, particularly Sabjar Ahmed sir, for giving us opportunity to host this event. So thank you, and thank you all, and have a good night. Thank you.
Thank you very much, sir. Thank you very
Thank you,
much.
sir.